Just a month ago, Bitcoin was the star of the financial world, soaring past $126,000 and grabbing headlines everywhere. It felt like the entire city was buzzing with excitement, and you could almost sense the electricity in the air. People from all walks of life were talking about it, from taxi drivers to baristas, and it seemed like everyone wanted a piece of the action. With every new price alert, the celebrations grew louder. Social feeds were a sea of green, filled with rocket emojis and bold predictions. It was as if the party would never end, and the only direction was up. Friends who had never cared about crypto before suddenly wanted in, asking for tips and bragging about their first buys. Greed was everywhere, and FOMO, the fear of missing out, was at an all-time high. It felt like a gold rush, with everyone convinced they'd struck it rich. But fast forward to today, November 12th, 2025, and the mood has completely flipped. Bitcoin has plunged below $106,000, erasing weeks of gains in just a matter of days. The headlines are now filled with words like crash and panic, and the optimism has vanished almost overnight. On the streets, you can see the anxiety. People glued to their screens, nervously refreshing price charts and scanning for any sign of hope. The euphoria has been replaced by uncertainty and fear, and conversations have shifted from dreams of Lamborghinis to worries about losing it all. My phone is now full of worried messages from friends and family. Should I sell everything? Is it too late to get out? The same people who were celebrating just days ago are now second-guessing every decision, desperate for reassurance. This emotional roller coaster is classic in crypto. One day you feel like a genius, riding the wave of success, and the next, you're doubting every move you make. The swings are intense, and it's easy to get swept up in the crowd's emotions. That's why smart investors know they need more than just gut feelings. They look for tools and data to help them cut through the noise, to separate fact from fear, and to make decisions based on logic rather than emotion. Enter the Bitcoin Fear and Greed Index, a single number that measures the market's emotional temperature. It's like a weather report for investor sentiment, showing whether the crowd is driven by fear, greed, or something in between. With this tool, you can step back and ask yourself, is this panic rational or just raw emotion? In a world where fortunes can change in a heartbeat, having a way to check the market's mood can make all the difference. So, what is the Fear and Greed Index? It's a daily score from 0 to 100 that quantifies the crypto market's mood. 0 means extreme fear. Everyone's selling. 100 means extreme greed. Everyone's piling in. Around 50 is neutral. The idea comes from Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. The index helps you spot when the crowd is getting carried away. It's built from real data, volatility, trading volume, social media buzz, and Google search trends. Think of it as a health check for the market's emotions. It's not a crystal ball, but it's a powerful tool to see if the market is overheating or panicking. Instead of guessing, you get a clear snapshot of sentiment. Let's break down how the Fear and Greed Index actually works and what it really means when we talk about fear in the markets. This index is a tool designed to measure the emotions and sentiments that drive investor behavior, especially during uncertain times. It's not just a number, it's a reflection of how people are feeling, reacting, and making decisions with their money. The index is built from 6 key factors, each chosen because they capture a different aspect of market psychology. These factors are carefully weighted to give a balanced view of what's happening in the crypto world. Volatility and trading volume are the biggest contributors, each making up 25% of the index. When prices swing wildly, or when trading activity suddenly spikes, it's often a sign that investors are nervous or even panicking. High volatility is a classic signal of fear. People are uncertain, and that uncertainty shows up in the numbers. On the other hand, surging trading volume can sometimes mean greed, as people rush in hoping to catch the next big move. It's a delicate balance, and the index tries to capture both sides of the emotional spectrum. Social media activity and survey results each contribute 15%. These factors track how much people are talking about crypto, and more importantly, whether their conversations are positive or negative. Are people excited or are they worried? Are they sharing good news or warning others to be careful? By analyzing the tone and volume of these discussions, the index can sense the overall mood, whether optimism is spreading or if fear is taking hold. The last two factors are Bitcoin dominance and Google trends. These round out the index by showing where attention is shifting. If more people are searching for terms like Bitcoin crash, or if Bitcoin's share of the market suddenly rises, it's a strong sign that fear is on the rise. When investors flock to Bitcoin as a safe haven, or when search interest in negative news spikes, it's a clear signal that anxiety is spreading through the market. Today's reading is 26. Volatility is up. Social media sentiment is negative, and Bitcoin dominance is climbing. All these signs point to a market that's feeling nervous, with more people acting out of caution than confidence. This isn't just a passing mood. It's a collection of real data points, showing that people are making decisions based on anxiety, not excitement. The index helps us see these shifts in behavior as they happen. By quantifying fear, the index turns vague feelings into something you can actually measure and track. It's a powerful way to understand what's really driving the market. So next time you see the index drop, remember, it's not just vibes, it's a measurable shift in how people are thinking and behaving with their money. That's what makes the Fear and Greed Index so useful. It gives you a window into the collective psychology of the market, helping you make more informed decisions. Right now, the Fear and Greed Index sits at 26, deep in the fear zone. Just days ago, it was 21, the lowest in 7 months. A month ago, it was 74, full-on greed. This wild swing is why everyone's glued to the index. Fear means buyers are waiting, holders are panicking, and selling feeds more selling. It's a feedback loop that can spiral fast. The speed of this shift from euphoria to fear in weeks reminds us how quickly crypto sentiment can flip. For beginners, a low index is scary. For veterans, it's a signal to pay attention. The index doesn't predict the future. It tells you how people feel right now. That's why it matters. Why did the mood sour so fast? It's a perfect storm. The Fed cut rates but signaled no more cuts this year, disappointing investors. Bitcoin ETFs, which brought in billions, suddenly saw $800 million in outflows. Big players started taking profits, spooking everyone else. On-chain data showed institutions buying less Bitcoin than miners were creating, a bearish sign. Even Ethereum fees are low, hinting at a slowdown across crypto. All these factors combined to trigger a wave of fear. The index didn't cause the drop. It reflected the growing anxiety. It's a classic case of macro and institutional moves rippling through the market. Downturns can feel like the end of the world, especially when headlines scream panic and uncertainty fills the air. But if we take a step back and look at the bigger picture, history tells a very different story. Time and again, markets have faced moments of fear and doubt. Yet, over and over, they found a way to recover and move forward. We've seen fear like this before. Think back to April 2025, when the index plummeted to 18. The mood was grim, and many believed the long bull run was finally over. News outlets ran with dire predictions and investors braced for the worst, but that overwhelming fear actually marked the bottom. Instead of collapsing further, the market found its footing and rebounded, eventually reaching new all-time highs. It's a pattern we've seen before. When fear peaks, opportunity often follows. On the other hand, October's greed reading of 74 was a different kind of warning. When optimism runs unchecked and everyone is convinced the good times will never end, caution tends to disappear. That's when the market becomes vulnerable. When everyone's greedy, the market is primed for a fall. It's easy to get swept up in the excitement. But history shows that excessive optimism can be just as dangerous as fear. This cycle of fear and greed repeats itself again and again. Remember 2018's crypto winter, when prices crashed and hope seemed lost? Or the sharp drop in May 2020, when panic selling took over. Each time, fear set the stage for recovery, and those who stayed patient were rewarded. The lesson is clear. Fear is a natural part of the cycle, not the end of the story. It's a signal that change is coming, and often, it's the moment when the seeds of the next rally are planted. Those who keep perspective and don't let emotions take over often find the best opportunities. By staying calm and looking beyond the immediate headlines, you can spot the turning points that others miss. History doesn't repeat itself exactly, but it does tend to rhyme. The patterns of fear and greed, boom and bust, are woven into the fabric of every market cycle. That's where the index comes in. It helps you see where we are in the cycle, offering a clearer perspective when emotions run high. So next time panic sets in, remember, don't let fear or greed blind you to the bigger picture. The story isn't over, it's just another chapter in a cycle that's played out many times before. Is fear always bad? Not for contrarians. When the index is low, it can mean assets are on sale, not because fundamentals changed, but because people are scared. Emotional selling creates discounts for those willing to buy. Contrarians use the index as a discount finder, satsai. Low scores mean potential bargains, but it's risky. Just because fear is high doesn't mean the bottom is in. Smart investors use fear as a prompt to check fundamentals, not just buy blindly. If the long-term story is intact, fear can be a great entry point. It takes patience and a strong stomach, but opportunity often hides in panic. The index is a tool for discipline, not a guarantee. Use it to think, not to react. Even now, some see hope. Welcome to Moonvember. Historically, November is Bitcoin's best month, with average returns of 42%. Bulls hope this dip is just a shakeout before another rally. The Moonvember meme fuels optimism, but it's not a promise. This year's macro pressures and ETF dynamics are new. Past performance isn't a guarantee, especially in crypto. Still, the hope for a seasonal rally shows how optimism persists, even in fear. The next weeks will test whether data-driven fear or bullish hope wins out. So, what should you do? Don't make emotional decisions. Whether it's panic or hype, step back and stick to your plan. If you believe in Bitcoin long-term, fear isn't a reason to abandon ship. Consider dollar-cost averaging, investing a set amount regularly, no matter the price. This smooths out volatility and removes the stress of timing the market. Ask yourself, has anything changed about why you invested? If not, don't let short-term fear dictate your actions. The index is a tool, not a command. Use it to understand, not to react. Manage your risk, stay patient, and let your plan guide you through the cycles. In crypto, discipline beats emotion every time.